Okay. In this session, we're going to look at the efficient market theory or hypothesis. Okay. So the efficient market theory or hypothesis, the reading, you can look at Brown and Matthias, chapter 13. They've covered it quite comprehensively. And Horsley and McGregor have sort of just done a very, very brief version. Okay. So what this theory relates to, it was developed for the stock exchange, for the stock market, really. So you see probably in the slides we'll be talking about the stock market. But the underlying argument there is that it is actually quite difficult to beat the market consistently. It's difficult to beat the market consistently. So it does focus on investors' risk management. But how does this apply to property? How does this apply to property? And also, does it have any implications to our property investment, particularly property management investment strategy? Does it actually have any implication? So we sort of going to try and look at these issues today. But before we look at that, we're going to talk about something called fundamental analysis. This is now the investment stuff, especially for the people that invest in shares, a lot in shares. We've got two camps. One is called the fundamental analysts, and the other ones are called the technical analyst. In your travels, or fundamental analysis or technical analysis, in your travels, have you come across these two? Has anybody come across these two? No? You've met them, Yitzen?
Yeah, when investing in shares.
When investing in shares.
Yeah.
Okay.
Not in property.
Not in property. Okay. So in terms of what the fundamental analysts do is they concentrate. They concentrate on some economic factors. They concentrate on some economic factors and do quite a lot of research, going through reports and so on. So if you heard about Warren Buffett, I don't know if the correct pronunciation is Buffett or you don't pronounce the T, or it's Buffett. I don't know. It's not my tribe, so I'm not sure. So let's say we pronounce it with a T. So Warren Buffett is mostly a fundamental analyst. That's sort of his investment strategy. So you take a company report and actually rip it out, read it and see what look if the fundamentals of that company are actually right. And also they look at the economic factors as well affecting a business. So what they are interested in is actually the intrinsic value. Because by looking at analyzing a company so much, they could actually have a view of what the intrinsic value is. They could actually have a view of what the intrinsic value is. So if they think that a company has got a higher intrinsic value than, say, what it is trading, they are going to they are going to invest in that company because they are thinking actually this company is worth more than what the share price is. So they are more interested in the intrinsic value. If they think it's got a lower intrinsic value than the share price, what they are going to do, if they've already invested in that company, they would sell. If they have not, they're not going to touch it. So in terms of the fundamental analysts, what they do in English, they're saying that the value of the asset depends on the economic factors. And so things like investments, things like interest rate, risk, and so on, it does affect companies. So what they're interested in so much is the intrinsic value. So if they think the intrinsic value is higher, they could invest in the company. But of course, they're going to take the transaction cost into consideration. Because if it's only slightly higher and there are more transaction costs, then it won't be worth their while. So the argument is that actually the value of businesses float around the intrinsic value of or rather the stock price of businesses float around the intrinsic value of those business. And this actually can create profits for the investors, profit and also losses for the investors. So what the fundamental analysts actually do is they will look at the aggregate market analysis, they will look at the company itself, rip it apart, and also they would also look at how the company is managed. They also look at how the company is managed, and they're going to form a view on that basis. So they're going to form a view on that basis. So there's quite a lot of research that goes around. That we're going to contrast with a technical analyst in a bit. That's what we're going to contrast with a technical analyst in a bit. Okay. I think in the slides that are coming, I'll just put everything and then I'll be discussing. So of course, if they're going to look at if they're going to look at company reports, they're going to look at market reports and so on. They're really looking in the past. They are really taking into consideration how the past has been, and looking at that, they can try to look at the focus as well of businesses, and also look at the earnings growth as well. But there is an argument that okay, is this really accurate? Is this really accurate? Because it could just be a way of extrapolating the past. So you're looking at the past, because when you're looking at the information of a company, it's actually something that has already happened. So until just trying to extrapolate the past. So they're saying that actually it's sort of not really that bad, because less than about 2/3 of forecasts are within 25% of the actual results of businesses. So there is something there, because people make money out of actually analyzing company reports, analyzing the market itself, and so on. They analyzing the whole sector. So even if it's looking at the past, there is sort of some value there.